Hello, this is Steve Sanangelo once again from the SRS Rock Report, and today I'm going to do an update. I actually started doing this update last week, so some of the charts are from January 4th, but I've updated most of them. But it's this ongoing theme I see taking place with the broader markets, the Dow and the precious metals, gold and silver, and the continued disconnect in 2019. Now, this next chart I'm going to explain in the latter part of the video, but I wanted to tease you with it because we already saw this disconnect take place in 2008, and we're starting to see it already at the end of 2018 and 19. But I think it's going to continue this year, especially this year and into 2020. But before I get to that, I want to quickly go over these charts. Now, I did publish these charts in a recent article. I have updated them. Now, one commenter on my website mentioned that I had possibly cherry-picked the information so it makes it look like the precious metals are doing better. But that wasn't the intent. What I wanted to show was many analysts had, even Clive Mon, who does an excellent job of technical analysis, they were forecasting that the metals were going to sell off with the markets. And we didn't see that. And I've been saying it's actually and several times this year, the metal prices have gone up when the markets have really sold off. Now, if we look at the Dow Jones at the beginning of December, it was at 26,000, and then it had a huge correction, fell down to a low, and it had the worst Christmas Eve ever in its history, and it fell to, it was 21,800, and then the next day of trading after Christmas, we saw a big move up, and it's moved back up to this 24,000 level. So still, even with this huge reversal, it's down 8% since December 1st. Copper is down 7%. The oil price, even though it's moved up a lot, it's down 4%. We have to remember oil was at a high of $77 in October. Even though it's corrected higher, it's still $26 below its high of just 3 months ago. Now the gold price, this says -5, it's +5. In December 1st, the gold price was $12.25, and then on Friday it closed right around $12.90. It's up 5%, and the big winner is silver. Silver's up almost 10% since the beginning of December. Now, so here we can see from December to January 11th, Dow's down 8, oil's down 4.5, copper's down 7. These are all indicators of the health of the economy. If there's deflationary, they go down. If it's inflationary, they go up. And then we can see gold and silver have gone up while the markets have gone down. And that's really what I wanted to show you. This is let's say, a short-term disconnect. Now, I wanted to start with the oil price because it's a very important indicator of the overall health of the economy. And a month ago, I showed a similar chart. Now, for new people, this is the oil price, West Texas Intermediate oil price. It is a monthly chart. So all these candlesticks show you a month worth of trading. We see the prices here, and then these are the years here. So as I've stated, the oil price trades around these moving averages, and we can see it clearly right here. Now, when the oil price peaked in October at 77, it started to sell off. And then when I showed you, it was stuck in between these two moving averages. And I said it was going to fall because it was December. This was the economy was weakening. It's normally the weak time of year for oil. There's less demand for driving in the winter months. So the oil price fell. And where did it fall? It fell right down to this 400-month moving average. And then oil did exactly what I thought it would do. After selling off for 3 months, if it did bottom here, it moved back up. And it moved right back up to these two moving averages. Now, what's interesting, when you have two moving averages converging, and you can see it here, you've got the red 50-day or 50-month moving average. Again, this is a monthly chart, so these are monthly moving averages. And then we have the pink 300-month moving average. When the oil price is below it, or any stock or asset value is below two converging moving averages, it's like a stronger resistance. So I believe oil will more likely continue to fall as the fundamentals of the economy continue to weaken. So we could see lower oil prices over the next couple quarters. Now, people have been asking me about the Dow Jones. This is the Dow Jones chart. This is a monthly chart, and these are the moving averages here. We could see that there has been no real significant correction down to these moving averages. So the Dow still remains overextended, or what they call overbought. But this was the first day of trading on January 2nd. We could see in December, the Dow Jones fell all the way down to here, and that was the low on Christmas Eve, and it moved back up. And it closed at the end of December right at the 25-month moving average. Now, on the first day of trading, it went right back to it. On the second day of trading, which is the third, the Dow sold off 500 points and moved down here. And on the fourth day of trading, when I did this video, we could see it went right back up to the 25-day moving average. So what's happened in the past week? Well, the Dow went right back up and tested the 24,000. And I called this the major support level last year, as the Dow continued to go down to it and trade off of it, but it didn't close below it. Now, what do we have here? The Dow started trading and moved up to this, and this is what's fascinating. On Friday, it closed at 23,995.95. It closed almost right up to the 24,000 level. Now, I have added the 12-month moving average in brown. You can see it here, and it's half of the 25. We see that the prices move around intervals of these round numbers. But right here, this was October and November, we could see the 12-month moving average was support. It fell right down to it. What's going to happen now in January? We could see the Dow push up to this level. It's 24,000, let's say 815. We could see, like these wicks, these long wicks here, we could see the Dow continue to move up, touch that. But I do believe, because we're having a weaker economy, I do believe the Dow is going to fall and close at the end of January below this 24,000. So it will likely continue to sell off over the next several months, and then in 2019. Now, copper. While the Dow is a major index of the market, copper is a indicator of the industrial sector, what's happening with the industrial sector. And we could see, this is a monthly chart, and we could see the copper price falling and remaining on this 250-month moving average for almost a year before moving up, going to this moving average here, and then it started to sell off. Now, what's interesting, we could see the copper price has been trading in between these two moving averages. And it provides resistance and support. Now, what's interesting and fascinating, I keep mentioning that word, but just like oil traded last month, it was stuck in between two moving averages. Copper has done the same thing. And I did this chart back on January 4th to show you that copper was trading in between these two. You can't see it here, but it's trading in between these two moving averages. So what's happened in the past week? Not much at all. The copper price has gone up 1 penny to 266. So in a week's time, it's gone up and down, but it's traded still stuck in between these moving averages. Now, there's no coincidence that the price is trading in between these moving averages. Now, where is copper going to go? Well, this shows that it's more of a bullish. If it's got a longer wick on the bottom, it could go higher. It may go higher. But because the indicators show that there's still weakening, I do believe, and as the price of copper moved up and now it's moved down, it's fallen here, I do believe it's more likely to fall. We're going to have to wait and see. But when copper does fall between these moving averages, it's going to go down to this $2.28 250-month moving average. Now, how about the silver price? What's happening with the silver price? Well, looking at the long term, we can see that this 50-month moving average provided resistance all the way down. And we could see silver was trading between these two averages, and then it fell below it. Now, why did it fall here? Before I get into its moving up, why did it fall down to here? Well, If we add the 250-month moving average halfway between these other, that's exactly where the silver price fell. So it's now moving up to this moving average, but guess what? We see a convergence of not two, but three moving averages now. We've got the 25-month, the 50-month, and the 200-month, all right here. So what that says in technical analysis, that's very difficult to breach that. And that level is 1642. However, when silver finally does breach it, it becomes a major, major support level. So I do believe when the markets really start to sell off, there's fear, and it may take some time. It's not going to happen like this month or next month. But when there's a lot of fear, we're going to see the precious metal prices move up. Then it'll move up above these moving averages, and we'll see higher prices. And this is the next resistance level, this 2195. But I do believe we're going to see a continued disconnect, and I'll get to that later. But silver will probably outperform gold when this happens. Now, I wanted to show you a few intraday charts because it gives more evidence of that these prices just don't trade willy-nilly. Now, this is a 1-minute chart of Newmont. This was done on January 4th. It was like between 2:30 and then the end of day at 4 o'clock. So it's about an hour and a half of trading. Now, I've mentioned this is the linear regression lines. We have the upper and lower, support here in the bottom, resistance, and in the middle. And then we have the moving averages here shown in these lines. So we could see Newmont moves up, falls right to it, trades on it, then it trades on the linear regression, trades on it again, comes back to the moving averages, comes back down to the lower linear regression line, trades off of the averages. So we could see it trades right here on this linear regression, goes up back to the top of the linear regression level, and then it comes back down, tries to touch the level, and then when it goes back up, sometimes the candlestick, now is the resistance level. But at the end of the day, we see Newmont goes right back to the moving average. So in just an hour and a half, we can see that the Newmont was trading up and around its technical levels. And it does it all day long, all week long, all month long. Now, if we look at Barrick, and Barrick's ticker was ABX, but since I did this chart this week, Barrick has acquired Randgold. And so Randgold Mining Company, they've changed their ticker to GOLD. Now, this is a weekly chart. Goes from the end of 2017 all the way to the beginning of 2019. Here we see the linear regression lines and in the middle, and then as well as the longer term moving averages. So we could see that Barrick was trading at the upper limit of the linear regression, came down, and then was trading around the middle, went back up around the moving averages, went back up here, went back to the linear regression, came down here. There's no coincidence that it traded right off this lower linear regression, back to the middle, back to the bottom, and then back to the top. Now, this could be a 1-minute ticker chart just like Newmont right here. So when you understand what happens on intraday, it's the same thing. It's the same kind of trading on a short-term intraday basis and a long-term daily, weekly, and monthly. So there is no coincidence that these prices, the stock levels, are trading around these technical levels and moving averages. And now these series of charts, and they were done on January 4th, it's market indexes and major stock price movements for 2 days of trading. It's January 3rd and January 4th. Now, I use the SPY index because I look at a lot of, let's say, the more well-traded stock, well-known stocks. This is AMD, Advanced Micro Devices. We've got Twitter and Google. So when the SPY, which is the S&P, it's the S&P ETF, you could see the way it trades. We can see that these other stocks are mimicking the index. Now, if we look at GLD, which is the Spider Gold ETF, it mimics the gold price. When the SPY index, the S&P, was selling off on the end of, let's say, towards the latter part of the third, the gold price moved up. And then when the SPY index shot up on the next day, the gold price sold off. And we could see it did the exact same thing for, here's Barrick, the new ticker, GOLD, Newmont, and Agnico Eagle. These three stocks, mining stocks, mimic the gold price. So again, it's just more of an indication, and I know people who follow this know this already, but a lot of people don't. If they look at just fundamentals, the stock prices move, and metal prices, commodity prices, all move around indexes and moving averages. So when you understand that, you get an idea of what's going to happen next. Now, a lot of people are wondering, is this 2019 market crash, economic downturn, recession going to be a repeat of 2008? And I think it's going to be worse. And who talks about that and just explains it is Charles Hugh Smith. He's got a great website, and I found this article on Zero Hedge. Now he says, crashes differ, so be cautious about your assumption. Even people who don't follow the stock market closely are aware that the global economy is weakening and appears to be heading into recession. Now, for those who track the stock market, the signs are ominous. The U.S. was the last major market to notch gains this year, and in October, the U.S. market followed the rest of the global markets into an extended slide, which has not yet to end. Just as sobering, key sectors as oil, banking, utilities have crashed with alarming ferocity, reaching oversold levels last seen in 2008 as the global financial system was melting down. Now, towards the end of the article, he says to stave off this banking crisis and collapse in U.S. equities and real estate markets back in 2008, the Federal Reserve quietly provided trillions of dollars of short-term credit to European banks and opened currency swap lines with other central banks like Japan to supply however many dollars those banks needed to restore liquidity to the banking sectors. To put some numbers on these dynamics, according to Twos, and that this is the author of the article that this article is based on, global capital flows dried up 90% from 2007 to 2008, and global exports plummeted 22% within 9 months. Now, the long-term result of this global dollar shortage and emergency Fed policies of providing trillions of dollars in short-term U.S. dollar credit and swap lines is that the dollar is more dominant now than it was before the crisis. So the U.S. dollar is now the anchor commercial currency for countries representing 70% of GDP, global GDP, up from 60% in 2009. As Twos explains, the world's central banks effectively became the offshore divisions of the Fed conduits for whatever dollar liquidity the financial systems required. Now, it seems the current market downturn and looming recession is not a repeat of the dot-com recession or the 2008 global financial meltdown. What Charles believes, it's a combination of three. The current downturn arguably shares traits with three different kinds of recessions: the popping of asset bubbles, the credit currency mismatches and panic move to de-risk like the 2008 meltdown, and a classic business style recession and contraction, which we're now in. And I kind of showed this in an article I did recently, looking at the unemployment rate, because the unemployment rate is another good indicator when you start to see a peak in this cycle. Now, even though the U.S. has changed the unemployment figures, the way they present them, they're underestimating the unemployment. I still use them as an indicator. Now, when the U.S. economy or the U.S. oil production, conventional oil production, peaked in 1970, we had massive inflation, which caused a big recession. And so to offset that, we had to offshore our manufacturing because it became too expensive. So we turned to a service economy. We built big malls and strip malls and in houses. And to fund and to push that economy forward, we had the first bubble, the military spending bubble in the 80s. Military spending doubled in the 80s, and that helped bring the high unemployment rate from almost 11 down to 5% by the end of the 80s. And then we had the next recession, and then the unemployment rate went back up. And to get out of that problem, we had the next bubble, the high-tech bubble, the dot-com era. And then the NASDAQ just shot up. And then as the economy improved, unemployment rate fell back to 4%. And then we had another recession when the NASDAQ bubble popped and all the dot-coms. But that was short-lived because we started the 2000 bubble, which was the banking and housing bubble, the investment banking bubble. And then what happened there, we had the mortgage-backed securities, the unemployment rate fell. And then here in 2008-9, we had the next recession. And as you can see, and the recessions are shown in these gray areas, it shot up from about 4.5% all the way to 10. Well, at that point in time, we had what is now the last major bubble, the Fed and central bank bubble. So the unemployment rate continued to fall as the liquidity injections in the economy continued to improve superficially, and then the manipulated unemployment rate continued to fall. And now it's at 3.7, 3.8%. It's the lowest it's been in over 5 decades. Now, you'll notice this can't continue to go lower. And when it corrects, it doesn't take years. You could see all the unemployment rate really starts to move up very quickly and shoots up. So I think the 2019 is going to be a year that we're going to start to see the wheels fall off of the global economy, and we're going to start seeing more unemployment. Now, I want to show the oil price one more time because it's very important for a large sector of the U.S. economy now, because the U.S. economy, we have a lot of shale oil production, shale gas production. We're now known as one of the larger oil producers, but it's unconventional and it's very highly cost and unprofitable. But I wanted to show you this chart because I believe the goal of the oil price is going to continue to fall. It could move higher. There's no way that it couldn't move up to this next level, but because the indicators are weakening, I believe over the next several quarters, the oil price is going to fall. And that's bad news because the U.S. shale oil industry needs a much higher oil price. And this chart, which I've updated, I've already posted once, it's by Art Berman, and it shows many of the top shale companies, and only 1/3 of them were making money when the price of oil in the third quarter of 2018 was $69.75. And that's right here. Only 1/3 were making money. These two are breaking even. Well, right now, the oil price is $51.59. So a lot more companies, probably these here, are now losing money. So now, why is it so expensive? There are still people who say that shale, we're going to continue to produce more shale, it's still profitable, but why are the shale companies losing money? This next image will tell you the reason why. This is a typical layout of a shale well completion, and I believe it's in the Appalachian region up in the United States. It's a gas well. This is the wellhead right here. I believe we have some more wells here. They put a lot of wells now on one pad. This is the pad, the entire pad. You can't see all of it, but this is the entire pad. We have the water here. This is where they put the sand. It takes sand and water to frack to complete the well. What we have here are 20 rigs, and these are pressure pumpers. It takes 20 rigs. I have a buddy in the oil industry that told me that what you see in the middle here, they call it the missile. They take the sand and the water and fracking chemicals, and they use the trucks to pump under high pressure through the missile into the wells to frack the well. Just take a look at the amount of equipment, the capital, what it takes to produce these shale gas and oil wells. And this next image, it's a little blurry, I'm sorry, but it kind of gives you an idea of all the capital, of all the energy and manpower, equipment it takes to produce shale oil and gas. So here we could see these are the frac pumps and all the trucks. Right in the middle are the wells. We have, here is the sand and frac fluid storage are shown here. This is the water trucks. We have these, they call them frac blenders, and here's the missile here. and there's another missile here that pumps it into the wells. I mean, and then we've got chemical storage trucks. Just take a look at all this equipment. Now, this is the reason why Shell will never be profitable. It just takes an insane amount of equipment and capital and energy to produce it. Now, I've got two more charts to conclude, and I wanted to show you this chart because we see a similarity of what took place in December 2007 and 2018. Now, in December, after about 3/4 of a year of the Dow going up and down, it finally sold off, a large sell-off in December, and then it moved up. We had the same thing here. It was moving up and down in these two. It was a little bit larger level, but it was moving up and down these levels, and then it had a big sell-off in December. Now, what's interesting, we could see in January, the Dow has moved back up to this level. And I believe it could go even higher. But at the end of January, it's probably going to close below this. So this is kind of an idea of what we could see. The Dow is likely going to sell off because by 2009, it fell down right to the 300-month moving average. And for it to get back to this level, it would have to go down to 11,000, let's say 900. When I look at the markets and I look at different stock indexes, nothing goes up forever. It has to correct. It can't. So right now, the Dow is still very overextended. It's still very overbought. And it will need to move down and correct into these levels. We haven't even begun to do that yet. Now, why is that important with the major disconnect with gold? And in this final chart, which I'll explain, when the Dow was selling off in 2008, we saw the gold price moving up, and it moved up to about, I think it was $1,000 at the beginning of 2008, and then it sold off. And then it sold off with the markets. We could see little of that this year. We could see a little bit of that. But the difference is the gold price has not been moving up. It's been in this kind of flat trend. So in October, the Dow continued to fall for the next 5 months. But what did we see with the gold price? It disconnected and moved up. The gold price started to move up. Now, we see that right here. When the Dow peaked, the gold price moved up. So I do believe this time around, because there's so much more leverage, there's so much more anxiety with traders. They know when the markets really start to sell off. I think we're going to see a much bigger disconnect. We're going to see the gold and silver prices move up much higher and much more leverage than they did back in 2008, even in 2016. So I want to thank you for watching this last video. And if you have not yet subscribed to the SRS Rocket Report YouTube channel, please consider doing so. I do plan on putting out more fundamental analysis. I've got a new article or video that's going to be on all the debt that the U.S. government has that we don't know about. And I'm not talking about unfunded liabilities such as the Social Security and Medicare. I'm talking about debt that's on the balance sheet. It's much more than we realize. So thank you very much for joining me today, and have a good day.